Earlier,
Tyler, thanks for having me back.
You all called for a 5 to 10% correction in stocks, and we actually got that. We got it back like a 6% correction, but I guess you don't think that's quite the correction that's enough to correct the market. Why another 5% decline potentially?
Fair point. So from that 6% correction, we've rallied about 5% back almost to the old highs over the course of the last 3 weeks or so. Now, the reason for that, I think you touched upon it. We've had a pretty good earnings season. We're 90% of the way through earnings, but revenues are up about 4% year over year, earnings up about 6% year over year, and those are better than expected. That's the third good quarter in a row. But with earnings behind us, the market has to shift its focus to something else. And I think the question of stagflation that Chair Powell addressed from his presser last week is one that's going to come to the forefront. Look at that Michigan number we just saw this morning, Tyler. The Michigan sentiment number dropped by 10 points, but the inflation expectation increased by 0.3% for the next year. As we shift the focus of the calendar to next week, we're going to get updates on wholesale inflation, retail inflation, and retail sales. Our guess is that retail sales are going to be soft, and inflation, as Mike said, is going to be sticky and persistent, and perhaps that seeds this further correction that we might expect over the course of the second quarter.
I'll spot you the idea that inflation seems to be moving in maybe not the right direction, and maybe it's moving a little bit higher. But on the stagflation question, we had quite a conversation about it last week during the Fed meeting, and most people felt that we were nowhere near a stagflationary moment because when you look back to when there really was stagflation, number one, unemployment was a lot higher than it is today. And number two, so was inflation. It was a lot higher than it is today. So are we talking about the stagflation that we knew a few decades ago, or are we talking about another more benign form of it potentially? I don't know.
Excellent point. We're not looking at a revisiting of the stagflation we saw in the late 70s and early 80s. What I'm referring to, Tyler, is directional. You look at GDP, gross domestic product, over the last 3 quarters. We were at 4.9% in the third quarter of last year, 3.4% in the fourth quarter, and more recently 1.6% in the first quarter of this year. So the economy is slowing. Yet inflation, measured by the CPI, nominal CPI, has actually gone up over the course of the last 3 months. We're seeing the base effects of benign contributions to that inflation rolling off. We're replacing that with higher levels of inflation with energy, electricity, food, housing, wages. And that suggests that directionally, we could be looking at slower economic growth and higher levels of inflation. But by no means are we looking at late 70s, early 80s levels of stagflation.
Great answer. Let me just say, given that hypothesis, what sectors of the market should I be looking at, and where might a pullback take the biggest bite?
Well, the reality is that the stock market's up 10% in the first quarter of this year, up 28% since the end of October through the end of March, largely driven by, AI FOMO with the Mag 7. So let's say we were to get hypothetically a 10% correction from these levels over the next, quarter or two. I would argue that it's the Mag 7 stocks that have done really, really well. A 10% correction, maybe those stocks will be down 20%. And the other stocks, domestic large cap value, small cap growth, international stocks, which have not participated to the same degree, maybe those stocks will be down, marginally to 5%. So I think we've got to just be a little nimble and play a little defense here until we've got a better sense of what the trends are on both economic growth and inflation.
All right, a few dink shots, not slams. That's what we'll go for, Phil. Phil Orlando.
Was that a pickleball reference?
That was a pickleball reference.
Wow.